Welcome to TalkTickers. Today we're going to be doing a deep dive into the recent earnings call for FNF. So what are the big headlines listeners should take away right from the start?
Well, overall, it looks like the combined business, delivered pretty strong financial results in the first quarter.
Okay. Strong how?
Specifically, the title segment hit an industry-leading adjusted pre-tax title margin. That's pretty significant. And they kept generating strong free cash flow, which is interesting because it happened during a time of, pretty low transactional volume overall.
Right. The market's been sluggish.
Exactly. And on top of that, the FNG segment also showed some profitable growth in its assets under management.
Okay, great summary. Let's dig into that title segment first then.
Right.
You mentioned the profit margin. What really drove that strong performance there?
So both their adjusted pre-tax earnings and that adjusted pre-tax title margin saw increases year over year. And if we look closer, purchase order volume had that typical Q1 seasonal dip kind of expected. But what's interesting is April.
What happened in April?
Well, the daily purchase orders opened actually picked up compared to Q1 and Q4 of last year. Now, it was still slightly down compared to April 2023, but an uptick from recent quarters.
And mortgage rates have been all over the place. How did that impact the refi side of things?
Yeah, the refinance business definitely reacted. They saw daily orders open jump pretty significantly, both year over year and quarter over quarter in Q1. Yeah. And that trend held into April, too. It just shows how sensitive that part of the business is to where rates are going.
Now, you also mentioned commercial revenue earlier. Sounded like a highlight. Second best first quarter.
That's right. Yeah, really strong commercial performance. And it wasn't just one area. It came from both their national and their local operations.
Okay.
For the national side, the daily orders opened have actually been up year over year for 4 straight quarters now. That's a solid trend. And the local market daily orders saw increase too. So putting it all together, they averaged about 5,600 total orders open per day in Q1. April saw a little dip compared to March, but still strong overall.
It sounds like management feels their tech investments are really starting to pay off here, especially with margins.
Absolutely. They made a point of that. Their view is that this tech isn't just helping them navigate this, lower volume trough,
right,
but it's actually setting them up to hit even higher margins when the next cycle peaks. That suggests, real fundamental efficiency gains.
And they're putting that cash flow to work, it sounds like, not just sitting on it.
Exactly. They talked about dynamic capital allocation. So that means returning capital to shareholders, think dividends, buybacks, but also investing back into the business. Technology, growth initiatives, maybe M&A, getting the right talent.
And they did start buying back shares again.
Yeah, they resumed repurchases towards the end of Q1. That usually signals some confidence, right?
Yeah, typically. They also mentioned seeing opportunities because of the current market volatility. How does that fit in?
It seems like they're actively looking, how can we use this choppiness to our advantage? Probably through those investments we just talked about, maybe finding some good acquisition targets.
Makes sense.
And on the income side, things look stable. Their interest and investment income for title and corporate was pretty much in line with last year.
Okay.
And they're expecting roughly $85 to $90 million per quarter for the rest of this year, assuming we get those couple of Fed rate cuts. Plus, you've got about $29 million a quarter coming in as dividends from their FNG stake.
Always important to ask about risk. What about title claims?
Good point. So claims paid out were actually higher than what they'd set aside, their provision, for Q1.
Okay.
But, and this is important, their overall reserve for potential future claims is still sitting comfortably above what their actuary estimates is needed. So they're still maintaining a cautious buffer there.
Got it. Okay, let's pivot then to the FNG segment. Sounds like assets under management are growing nicely there.
Yeah. AUM, before accounting for flow reinsurance, saw a pretty big jump year over year.
What's driving that?
It's mainly strong sales in indexed annuities. That seems to be the real growth engine there right now. Retained AUM is a big chunk of that total.
But didn't their overall gross sales actually go down? That seems counterintuitive.
It does at first glance, but it was actually a strategic move. The drop in gross sales was mostly because they pulled back on MIGA sales.
MIGA being?
Multi-year guaranteed annuities, kind of a simpler, often lower return product. They're deliberately shifting focus to what they see as higher return businesses.
Like the indexed annuities you mentioned.
Exactly. Indexed annuities and also pension risk transfer. If you actually exclude those MIGA sales, their gross sales went up.
Okay. That clarifies things.
Yeah.
But it looks like this shift maybe put some pressure on FNG's margins in the short term?
It did, yeah. Adjusted net earnings for F&G were down year over year. There were a few reasons: some near-term spread compression, lower margins from their own distribution channels, higher interest costs, and also lower returns from alternative investments.
So headwinds.
Definitely some headwinds. But management seemed to signal they think this margin pressure is mostly temporary. And, the fact that FNF itself actually increased its ownership stake in F&G recently.
Right, they participated in that stock offering.
Yeah, that suggests they still have a lot of confidence in F&G's long-term growth. The money raised will help F&G keep growing that AUM too.
Okay, zooming back out to the consolidated picture, the whole company, how did the overall numbers look?
Well, they reported total revenue, both with and without the impact of net recognized gains and losses. Those can swing things around quite a bit based on market moves.
Sure.
Net earnings were hit by some recognized losses, but adjusted net earnings were actually up year over year.
And the title segment was the main driver of that adjusted profit.
Yeah, title contributed the lion's share, followed by F&G and then the corporate segment. We also saw direct and agency premiums in title increase significantly.
But costs went up too.
They did. Personnel and other operating expenses in title also rose, but, that tends to happen when premium volume goes up. Importantly, their overall debt levels and their debt to capital ratio are still well within their targets. They have a solid financial structure.
Right. And you mentioned the share buybacks earlier, plus they have cash.
Exactly. They resumed buybacks, and they've got a pretty healthy cash balance at the holding company level. They've been using that cash for dividends, paying interest, that F&G investment we discussed, and the share repurchases.
Okay, so looking forward, what's the outlook? Did they give much specific guidance?
Not really on open orders, no. They cited the economic uncertainty, which is understandable.
Right.
But management did emphasize their team's experience, managing through different cycles. The focus is still squarely on investing in the business acquisitions, tech.
Any updates on specific tech?
Yeah, they mentioned their in-ear digital transaction platform is now deployed nationwide. That's a milestone.
And M&A. You mentioned that possibility earlier.
They expect M&A activity in the title segment to be higher this year than last. The focus seems to be on smaller tuck-in type deals.
Okay.
But they didn't rule out potentially larger deals, maybe in ancillary services or technology businesses.
What about the outlook for those title margins specifically? Q1 was strong. Can they keep it up?
Well, they said the Q1 margin expansion was pretty broad-based, not just one thing. Their overall view for the full year hasn't really changed much. They expect maybe modestly better purchase volume, potential upside in national commercial, and maybe in refi if rates cooperate and come down. They do expect margins to expand again in Q2 compared to Q1, but the pace of that growth is still a bit uncertain.
And commercial strength holding up.
Seems like it.
Yeah.
They highlighted multifamily, industrial, affordable housing. And interestingly, they mentioned seeing some anecdotal signs, maybe early signs, of office transactions starting to pick up too.
That would be significant if it continues. Any regulatory updates?
Seems relatively quiet. Federal concerns around the CFTB seem to have died down a bit. There's a small waiver pilot program, but not many lenders are participating.
Okay.
State level, there's a rate reduction in Texas that's under administrative review, but no impact right now. And just a minor rate or split change happened in New Mexico. Nothing major seemed to be flagged.
So if you had to boil it down, what are the key takeaways for listeners from this whole call?
Okay, I think first, that strong title margin, even with low volume, really underscores their efficiency gains in tech investments. That's a potentially bullish signal for when the market turns.
No operating leverage.
Exactly. Second, F&G's strategic shift towards indexed annuities and pension risk transfer. Even though gross sales dipped short-term because of MIGA, it shows a focus on a higher return, potentially more stable long-term business. Third, FNF putting more money into F&G shows confidence and keeps their options open strategically. And finally, restarting share buybacks plus having that cash pile suggests they're committed to returning capital, but also ready to pounce on opportunities like M&A.
Okay, that sets the stage nicely. Now let's move to our favorite segment. This is not financial advice, where we toss around some outrageous but plausible trade ideas. What's cooking this time?
All right, idea number one. Given FNF's really impressive title margins despite the slow market, plus their talk about doing more M&A, you could consider a long position in FNF itself. The bet is on those efficiency gains continuing, and maybe some smart acquisitions adding value, especially if the housing market eventually recovers.
Okay, but what's the hedge? The market's still shaky.
Right. So to hedge against that broader housing market uncertainty, you could maybe pair that long FNF position with a short position in, say, a basket of home builder ETFs. The idea is to capture FNF's company-specific improvements while guarding against ongoing weakness in the overall real estate transaction volume.
Interesting. So betting on FNF's execution while acknowledging market risk. Got another one?
Yep. Second idea focuses on F&G's shift. Remember, they're pushing into indexed annuities and pension risk transfer, growing AUM, even with that short-term margin pressure.
Okay.
So consider a pairs trade within the insurance space. Go long FNF, benefiting from its diversification and that F&G growth story.
And the other side of the pair.
Go short a company that's maybe more of a pure play traditional fixed annuity provider. The thesis is that the trend towards indexed products and PRT could squeeze companies stuck in the traditional fixed annuity space, especially if interest rates remain volatile or rise.
Playing the product shift trend. Okay, fascinating ideas as always. But everyone, please remember, this is TalkTickers. Nothing we discussed here is financial advice.
Seriously.
Absolutely. You have to do your own homework, your own research before making any investment decisions.
Definitely dig into FNF's reports yourself, look at the industry trends, and make your own informed choices. Thanks for tuning in.